the world blew up in 2008. The world is now entirely about the management of the debts. And there are two ways for that to happen. If we didn't do quantitative easing in 2008, 9, 10, 11, all of that stuff, the world would have burnt and destroyed in the manner that you thought.
Hey guys, welcome back to Library of Wealth. Real Vision CEO Raoul discusses the global financial crisis we're seeing unfold and how the current economy is eerily similar to the collapse of 2008. In 2008, the world witnessed a dramatic plunge in asset prices, triggering a whirlwind of consequences known as the collateral spiral. As central banks resorted to quantitative easing, it took a grueling 6 months for the tumultuous collateral prices to find stability and debts to become more manageable. The devaluation of currency and the subsequent rise in inflationary pressure is currently unfolding as the Federal Reserve's balance sheet expands rapidly amidst the ongoing financial crisis. Raoul sends a warning to all investors that nothing can stop the coming collapse and to prepare for the second half of 2023. Let's get right into the latest interview with Raoul. Don't forget to hit the like button and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
Is it something I call the magic formula? Magic formula is economic growth. Economic growth is driven by three factors and three factors only at long-term level, aside from just the normal business cycle ups and downs. Population growth. The more population you have, the more your economy has activity. So population growth, well, population shrinking the entire Western world. The only way of offsetting that is immigration. But we talked about the fact that the workers are angry, they can't get wage rises. There is less of a desire to have immigration than there was maybe 20 years ago. So most countries have started to restrict immigration. Fine. So there's no way of solving the population side. The next part of the magic formula is productivity. That's how much output each of us can generate for the economy, and that becomes more efficient. Problem is, it seems to be a function of demographics too, and productivity has been declining since the 70s. Well, actually since the 50s. So productivity is going down. The population is shrinking over time. So the answer was debt. The answer all the way through this equation from these people who were sold the American dream back in the 1950s, the baby boomers. They're listening to Elvis Presley, getting into the Beatles. They're like, let's go, the American dream, I'm going to get rich. But as we pointed out, their wages never went up. But because there were so many of these people, they competed for houses and houses went up. They invested in the stock market went up. Everything, all assets got more expensive because of their demand. So they did the rational thing, which is I'm just going to borrow money. And the difference between the rise of the assets and their wages is essentially what the debt was. The debt side of the equation is what the government's done too, because GDP is declining. The trend rate of GDP keeps going down. If you see the Chinese economy, and what happened is they did the same. They had population coming in, productivity probably rising, but then they massively borrowed money. So they had the fastest growing economy in the world for a long period of time. Leverage gives the illusion of growth, but obviously it has a payback later. And this is the payback we've got now. The leverage the baby boomers took on, their governments took on, and the corporations took on for all of this issue is what we're dealing with now. So wages didn't go up, assets went up because they were competing for them, like you're competing for scarce resources of people right now. But when you put 76 million people in, the housing market goes up, the stock market goes up because they start pension plans and stuff like that. So the difference is debt. And that was okay. Although we were all starting to look at this saying, whoa, this is now getting absurdly debt laden. The government's 100% of debt. The private sector's 100% of debt. Households are 100% of GDP in debt. It's like, whoa, this is out of control. Then 2008 comes along. And that is the debt crisis. I mean, every bank blew up. I mean, everything blew up. It was a complete, total collapse. And that rolled on into Europe in 2012 when the governments, Spain, Italy, etc., blew up. And all the banks in Europe blew up. Hyperinflation is when you issue more money to pay your debts, and it comes in an endless cycle because you're not generating GDP growth, you just keep printing money. So an excess of anything in extremis, everything becomes worthless. So if you're thirsty and you've come out of the desert and somebody gives you a bottle of water, you'll pay pretty much anything for it. If somebody's there with 1 million bottles of water, what's a bottle worth to you? Almost nothing. Once you've had the first one, right? So anything in excess supply, it's just supply and demand. Too much supply of currency, the value goes down. So what happened in Germany is they had these gigantic, impossible to pay debts to the West. So they printed as much money as possible. That blew up spectacularly. Prices rose millions of %. And every time you got paid as a German citizen, that fistful of notes barely bought you a loaf of bread one day and half a loaf of bread the next day, and then nothing at all until you have wheelbarrows full of cash. And we've seen this in Argentina, we've seen it in Venezuela, we've seen it in plenty of countries. We just saw it in Lebanon recently as well. That's a total collapse of the value of a currency. Okay, so therefore, all of your productivity as a human is devalued as well, because you can't buy anything. So you end up having to ignore currency and barter. And we've seen that in many places as well, because the value exchange of a currency in the middle, because it falls so fast in value, it's a nightmare to deal with. And it's a total destruction of wealth, except those who own assets. Real wages have not gone up versus prices. So if you look at I don't know what peak wages were, but let's say they were 6% last year, year-on-year wage growth, but peak prices were 9%. So people actually got poorer, which is why we've got a recession going on, because everybody lost purchasing power versus just basic goods.
So would you say we are in a recession already?
Yes. Yeah, by every indicator I've got, we're in a recession already, and it will become more abundantly clear. The other thing I think is a point that's also important is we need to think about total aggregate demand within an economy, and who are you giving those increased wages to, right? So yes, you are paying more for scarce labor, certain skill sets, expertise, whatever. But when the labor force participation rate is only 65%, you have to average that over 65% of the economy, not 100%. And that's the function of demographics.
Once again, the unpredictable nature of the markets has led to a shift in sentiment regarding the Federal Reserve's upcoming decision on raising interest rates. As cracks begin to emerge in the financial system, the initial plan of the U.S. Central Bank to potentially raise rates by 50 basis points is now under scrutiny. The past week has witnessed growing indications of turmoil within the global banking sector. Jerome Powell has been signaling a 50 basis points hike leading up to the next Fed meeting. However, escalating concerns about the financial sector's health in recent days have led to a more cautious approach towards monetary policy. It is a well-known pattern that when the U.S. Central Bank raises rates, it often triggers a chain reaction that exposes vulnerabilities in the financial system, potentially leading to crises. The Latin American debt crisis in the 1980s, the long-term capital management hedge fund crisis in 1998, the bursting of the tech bubble in 2000, and the U.S. housing crisis of 2008 are all reminders of what happens when big banks try to overcorrect bad monetary decisions from within. On the other hand, Raoul does believe that Jerome Powell and the Fed will decide to raise rates by 25 basis points at the upcoming meeting, while signaling a pause in further hikes for the time being. Such a move would effectively bring an end to the Fed's year-long cycle of monetary tightening, given the precarious circumstances prevailing within the global financial system. What do you think about the latest interview with Raoul Pal and his prediction for the market in the second half of 2023? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is the Library of Wealth. We'll see you in the next video.